so I guess we'll get started here. I get introduced. So Jesse is with Calvert Home Mortgages. At least half the people in this room probably know who Calvert is. Calvert is the premier private lender in Calgary, Alberta. And I know they also operate in Toronto, but here in Calgary, they have built, how many years now, Jesse? 50?
50, yeah, 50 years as a lender.
50 years, yeah. They've been doing this a long time. Specifically, they've been doing it in Calgary a long time. And why that makes a difference is because Calgary is very cyclical. So the majority of people in their company have been through multiple ups and downs in the market cycles. What Calvert is best known for is flipping properties. They work with investors to flip properties. They're better than anyone at it. They don't just make sure that you have security so that they're protected as a lender. They make sure that you're going to make money on the deal. They want you to have the best shot at making money. Now, it's not their job to make sure that you're doing that. But if they see holes in your business plan, an area you're buying in where they just look at it and say, yeah, we're good with you as a borrower. We don't think you're going to make money on this house. So go find a better house. And I have had that experience personally with them. I'm not a realtor. I don't have access to the MLS. So if I get a client that comes to me and they say, hey, I'm going to buy this house. My friend from work referred me, and it's not from Anthony or Santosh. I send those people to Calvert to do a flip. Calvert vets the deal themselves. They have the data that realtors have, but they also have more data on the costs, what things are costing, how long permits are taking, and they do this because at any given time they're in the middle of 40 plus flips. So if windows are taking an extra 6 weeks to ship, they'll know that. So that's just like, hey, by the way, you budgeted a timeline in here. You're gonna have to expand that out a little bit. Like they'll just have information that, because no one else does this amount of flips and tracks this kind of data the way that they do, they just won't have this information in the same way. So that's why I like to use Calvert. Now, I've used them as a mortgage broker for my clients. I'm also an investor with them, full disclosure, though I think I make up 0.002% of their overall MIC. It's a massive, very successful company. They've been around, again, a long time. So I work with them, trust them in every way that I can, but they're experts beyond what a typical lender is and also what a typical mortgage broker or realtor is. They have a very precise expertise in flipping properties. They're great for, buy a property, it's dilapidated, you can't get real funding on it, it's missing a kitchen. They go in there, we use Calvert, fix the property up, and then get regular financing on it. So they're good they do a lot. They do a little bit of construction, a little bit of this and that, but for investors, they do a lot of burst strategy type of stuff. But flipping is something that they are good at. That's about Calvert. Why I asked Jesse to come out to talk is none of those things. It's actually because they've been through so many market cycles. I've asked them, where do you guys see flippers fail? So anyone can make money in an upturn. But what about when the market crests? What about when the market's going down? Where do you see that people who were successful for 4 or 5 years flipping multiple properties, hit a wall or start losing money? Where do you see people make the biggest mistakes? Where do you see people who are successful in 3 or 4 flips hit a wall at 5, whatever the market might be? What neighborhoods still perform well in a downturn? That's all information that they have access to and that they track and that they pay attention to, because Jesse is one of the smartest people in my industry. And there's a lot of smart people in my industry, and he works for a great lender and some great individuals. I can't say enough. I could probably talk for half an hour on both Calvert and Jesse, but I'm just going to bring him up and let him do the talking, and we'll ask him a lot of questions. He'll probably stop and ask for questions in the middle of it if anyone looks confused, and then we'll berate him with questions after as well.
Thanks, Lane. Thanks for the kind introduction. Welcome, everybody. To Lane's point, what we're focused on here today is education. It's just passing on some of the knowledge that we have to a group of real estate investors or prospective real estate investors, with the whole idea of hopefully giving you some ideas or some thoughts on being more successful in your real estate investing or starting off as successful in your real estate investing. We work with the whole spectrum of real estate investors. Where we want to focus is those real estate investors who, one, are going to be successful because, selfishly, if they're going to be successful, likely we have built a client, Lane has built a client, realtors have built a client, wholesalers have built a client that will go well beyond one transaction. That's our main goal with every deal we underwrite is the client going to be successful? And if there's a yes, we're going to lend on it. On this deck, it still has my business development manager for Alberta, which is Kalen. You can feel free to reach out to him, to Lane, or anybody on the team, as well as myself, if you have any follow-up questions or ideas. This I will be providing to Lane and the team to provide to you guys, as well as any of the other tools that we have, and I'll get into what we provide with those. So in terms of our business, we are a mortgage lender. Now, we operate as a mortgage fund, mortgage investment corporation, and we manage a pool of money. And where our focus is on short-term lending. I'm trying to get this to move forward. And in that short-term lending theme, the bulk of what we do is lend to real estate investors. So for example, last year, our year end is February 28th. We lent out approximately $300 million to real estate investors. The bulk of that lending was to flips and burrs, and ballpark, the net profit or value appreciation and/or was about another $120 million on that. So quick, our mission is to be the most trusted lender in Canada so that our customers, investors, and partners succeed and grow and thrive in communities. Again, our goal is to partner with scaling and sophisticated real estate investors by building solutions, education, and tools to help them move faster, win more deals, and scale with confidence. And now, while we say scaling and sophisticated, a big part of what we view our role as is to be that educator. You've got a great team from a mortgage broker side, from a realtor side with Lane. Now we provide a look under the hood and use all the data points we collect over that 50 years with a scaling company. And by the way, those $300 million that we lent out were on approximately 800 properties. The bulk of those, were in Calgary. The next most amount of money we lent was in Edmonton, and then larger centers in Ontario. We're just getting going in Ontario. Got to make sure I click that. So back to Lane's point, this is not a pitch. What we'll be covering is what we've seen work, what we've not seen work, and talking about what does and doesn't in various real estate cycles. We were fortunate in Alberta for the last, call it more or less, since COVID. We've had a market that has seen higher than normal transactions, lower than normal inventory, and in turn, increasing values. For the last 9 months or so, it's been a bit softer. Inventory is a bit up. Values are not going up. In some markets, they're going down, particularly the condo market. And any cycle doesn't last forever. What does is sound decision making and some some key themes that I'll share through this presentation. So a little bit about, from a high level, what a cycle looks like. Again, this isn't perfect. This is very high level. But a downturn is where you have inventory over 4 months. Really, inventory is usually the leading indicator to price. When inventory is decreasing, which means supply is constrained, you're naturally going to have prices going up. When inventory is increasing, supply is going up, you're going to have prices going down. Usually you'll see longer days on market, so it'll take longer on average to sell a house. Of course, if you list sharp in any market, if you are the best comparable in any market, you are going to sell. And ideally, when you're flipping a house, speed is of the essence. We'll get into this, which is why you want to be sharp on your listing and sell. Your goal is not to squeeze out an extra couple grand to let it sit on the market for an extra 30 days. That is probably going to cost you more than the value of that. And then also the listing gets stale. You get significant depreciating returns the longer your property sits on the market. Buyer demand, again, is weak. Rental growth, usually flat to negative. And seller psychology, which does create an opportunity, is bearish. Right now, what's interesting is we've had a hot market for so long. Now we're in neutral territory, yet the seller psychology is still bullish, right? Like sellers still think we're back in a year ago, where that hasn't actualized yet. So now for flippers, which again, we'll get into this, the where your profit is 9 times out of 10 is in the buy. It's buying right. You can be the fastest to renovate. You can be the cheapest to renovate, and that's great. And that might, like I was mentioning, sorry, I forgot your name. To Reynaldo, who's a contractor, he might be able to work through a project for 30 grand where it costs the next guy 40 grand, 10 grand. Sure, he'll make 10 grand more profit, but in an average flip, you should see, we'll get into this, but 60K profit. So that's not going to make or break him. What's going to make or break him if he buys right or buys wrong and sits on it too long. So then we have a little bit about a moderate market again. Inventory is 3 to 4 months. This is the leading indicator. And this is very high level because not real estate is extremely localized. And I'll get into Ontario right now where it is very much a downturn, yet there's still pockets, neighborhoods, property types, townhouses, maybe single family, where there is tight inventory and prices are increasing, yet on a whole, it is a huge downturn there. So this is just something to pay attention to. I think for flippers, it's really important from the seller psychology, because if it's so much harder to buy when seller psychology is mismatched with market reality. Whereas now what we're seeing in Ontario is it's starting to stabilize, yet seller psychology is very bearish. So our sharp professional real estate investors are starting to buy. No, you do not have the tailwinds of appreciation, but most real estate investors who are successful are not speculators. They don't need the market to go up or down. They need to buy right, execute, and that's where their profit is. So a little bit about, I looked at the Alberta market as a whole in this, and Calgary is not too far off, but I'm sure EXP can give you all the data, and Lane can give you all that, and we can give you all the data. We produce a monthly economic report. We open source it to everybody. A lot of realtors just rebrand it and use it as their own, same as brokers. And it digs deep into these numbers on Calgary and Edmonton specifically. It looks at Alberta as a whole, and then we look at specific markets in Ontario. And depending on what type of client you are, we try to customize that economic information that you see. But today, again, in single family, for the most part, you're still in an up market where you got tight inventory, there is persistent demand, limited new supply coming on, and again, super localized. Like there's some stuff out in the suburbs where you have a lot more inventory. There's some stuff in certain neighborhoods where particularly I think the sweet spot is still like that $600,000 to $900,000 single family. Finding that in an existing neighborhood is really hard. So if you find an old house that needs renovations and in turn isn't appealing to the broader market, that's probably something you want to look at. Row townhouses, a little bit more supply, but still really good. Like it's still a robust market. There's lots of activity. If you find the right place, you're not going to have a problem selling. Whereas in the condo market, you have oversupply, and what looks to be the case is you got to look at what's coming online, and there's more coming online. So in all likelihood, you're going to continue to see that inventory rise, and in turn, softening in values. Now, as a flipper, probably stay away from that. But if you're going to buy a house and stay in it, it's impossible to time the market. You might want to wait a bit, but it's not, still from an affordability standpoint and value standpoint in the condo market, long term, if you look out 5+ years, you're still probably making a good decision if you're going to hold it. So next slide before I open it up to questions, because I'll stop for questions on certain segments of this presentation. Absolutely, real estate investors get caught in every market. So in a downturn, you're seeing margin compression. So the prices aren't on your side. Now, depending on what your business case is for the flip, and I'll talk about I'll talk now and probably have to talk about it again later. But the normal flips, the most successful flips we see is where you're buying an older home that needs renovations, i.e. old carpet, old kitchen, hopefully some deferred maintenance, because that's great. Because the less appealing it is to the broader market, the more likely you have a flip on your hands. And usually you're doing things like painting, flooring, kitchen, bathroom, call it 50 grand plus or minus. If you're suiting, maybe 100 grand. But usually you're in and out of these in terms of the actual renovations, 60 to 90 days, on the market for 30 to 60 days. So you're in and out in less than 6 months. And very rarely are you going to get caught where you see a massive downturn within that 6 month time frame. Like a 10% decrease year over year is significant and doesn't happen often. Now that is a 10% increase. Usually you'll see deterioration of like 5, 6, 7% over a year. And if that happens, yeah, your property might be worth 3 or 4% less than what you were thinking it would be worth when you purchased it. And that absolutely has an impact to your margins. Like, for example, on a $500,000 house, 4% is going to be 20 grand, right? So now you're 20 grand less than what you penciled into your profit. But execution breakdown is a consistent across all of these where you take longer. Project stalls, follow through slips. In COVID, you were waiting on supplies, right? Like great market, but hard to execute because you're waiting on supplies. And then certainly there is a liquidity risk in downturn. Like when, again, a downturn happens because the market is oversupplied. So now it might take you even longer to sell that, which just further compounds that issue of you're in a down market, you're taking longer. A lot of the seasoned real estate investors, when they get caught in that, the greedy get needy, and they won't get greedy, and they'll just rip the Band-Aid off and get rid of it. What doesn't work is when you hold, the market's going to turn in. And in Alberta, because of the cycles that we see, like these things happen often. Since I've been doing this for 20 years, every 6 to 7 years, right? So I've seen 3 different cycles, 3 different full, neutral, bull, bear. Whereas in Ontario, for the most part, through a whole generation, all they saw was it going up. So it was so hard for us to educate the flippers when it went down that like first loss is your best loss, move on. So many people held it to their detriment because we were having these conversations back in markets started going down in Ontario in March of 22, right? When we started, interest rates started going up, we started to have that monetary tightening. And they're like, oh no, we're gonna hold on 6 months, 1 year. Like properties only go up. And we're like, oh fuck, I don't think that's the right call. Here's what we've seen. And a lot took that advice, some didn't, and those that didn't, where we were talking to them 2 years ago and the market was down 10%, today it's down 30% overall in Ontario. So really important to, yes, if you can hold it, if you can cash flow it, by all means. But in all likelihood, you're not going to be able to wait out a cycle for the values to start going up again. Other things that we see, even in a hot market, overpaying, right? Like everybody gets caught up in, oh my God, I got to get in, FOMO. And it's easy to make money when things are going up 10% year over year, but you still got to buy sharp. And that is a consistent theme across here. But in a hot market, you can get caught up in that FOMO and buy because you're speculating. And I think people in this room want to be investors, not speculators. And that includes overconfidence. Like, yeah, I could just paint this thing and it'll sell. I don't have to do the countertop that it needs to be done. I don't have to do the cabinetry. I'm just going to slap a coat of paint on it. I'm going to sell. And it doesn't, shit. Now I've let it sit on the market. I've wasted time. Now I got to actually do the cabinets, bring it back to the market. Now it has a bit of a stigma. We want to avoid that. And then ignoring risk. This is the same with overpaying, where a risk, for example, when the market's hot, and I'm going to dig into this deeply, where you want to buy a liquid property. And a liquid property is something that is appealing to the broad audience. So a non-liquid property is the most unique property in the neighborhood. Maybe because it's the biggest, maybe because it's the smallest. A unique property is, oh, I got this great neighborhood. Let's use Lakeview as an example, Lakeview in Calgary. And like there's that row of houses along the power lines. Well, there's about a $30,000 adjustment for those. And you might get overconfident. No, I'm just going to value it the same as all the other comparables that don't have this negative influence. So that's where you can really get caught in a hot market. And we want to avoid that regardless. So any questions on the market and what works and what doesn't? And yes, Richard.
Imagine in a downturn, and this is probably where you guys shine the most, one of the biggest problems realtors would typically face is the financing probably gets more challenging, right? Like getting financing, because a lot of the economic conditions often change.
Yeah, the financing can, for sure. Although, and Lane would be more neutral than me on this, but for a good investor and a good buy, there's money. Like, have you ever seen where like you're like, there's no money available for a good deal?
Yeah, no, I mean, there's always money. There's sometimes not profit. And so specifically, what are you asking? Like,
he's asking about availability of financing, I think.
Like in terms of private money, or what? Like, what are you referring to specifically?
Well, no, not so much private money. I mean, that's pretty much always available in the deal, right?
Yeah.
But like larger institutional.
You mean like, do the banks stop lending if the market adjusts?
Well, yeah, I mean, what you might have qualified for before you wouldn't qualify for now. Or
guidelines could get a little bit tighter. Rates impact that, of course. With like CMHC and banks having kind of broad guidelines, it tends to not adjust that much. It is funny, in booming markets, they'll often kind of tighten up, not as much as they should. And then sometimes usually it's just like internal exceptions stop getting made. So they don't, if the market downturns, they don't just cut off funding because they're shooting themselves in the foot. You get the major banks stop lending on stuff. That means all their inventory that they have to sell or their clients have to sell to get out of a bad mortgage to go on, like they would hurt themselves by tightening lending too much. But the exceptions get challenging. So buyers dissipate, or there's too much inventory, and then it has far more of an impact than the actual financing getting tighter in that scenario. But I really want to reemphasize Jesse's point and the overconfidence. And we've had this discussion before where people are making money. They're like, hey, I buy this house, I do this to it, and I got this cookie. I've been doing this for 2 years now, and we just quit our jobs because we're making like 50 grand every time we do this. And it's like, well, how long does it take you to do this? Well, it takes us 7-8 months. And it's like, okay, well, what did the market do on its own? Like, what could you buy that property now for? Often people tend to realize that in a booming market like they were in, they were buying a property, doing renovations that added no value, but the 7 months it took them, like the worse they were at executing, the more profit they made because they actually took longer. But then it gave them this. Yet the market was actually doing all the heavy lifting
from market influences.
Yeah, and you have to separate and go, okay, wait a second. So assuming the market didn't do 50 grand of lifting, I only made 20 grand on this. Boy, I spent a lot of time doing this too. Like you really got to, and what if the market goes back 10 grand? Now I've put a lot of time into making only 10 grand or potentially losing money. And people tend to forget that, and they do forget it at the peak. That's why we do see people at the end of these peaks go from making a lot of money for a few years to all of a sudden losing a lot of money. And they've made other decisions, often quitting their job being one of them, thinking that this is their new job. And we have seen this. Have you guys seen people, or are you good at pre-vetting that? But have you seen people do that too? You do a good job of explaining, especially in Toronto, where nobody was explaining it to them for sure, because no one had ever seen it, or most people in the industry haven't seen a downturn. Do you guys see, like, what's your experience at this level or a year ago level where you're talking to people like, hey, I know you've been flipping houses, making good money. Make sure you're aware of what the market's doing for you.
Yeah, so from an education standpoint, we really try to isolate for what the market has done for them versus what they've done for pricing. And where they've actually built profit versus the market. And from an overconfidence standpoint, where people can get into trouble is where they're not back testing that, right? Like the clients that we do the most business with are constantly back testing, hey, how much money did I actually make? What is the market actually doing? And then using that mentality for the next purchase, as opposed to, I made money, I don't care how I made it. I made it. I'm going to keep making it. So backtesting that. But to your question on financing, I think overall Canadian residential real estate is very well financed. Like it's a real piece of our economy, and the banks are very motivated to lend to borrowers. You got this wonderful thing of mortgage insurance, which backstops the banks in a lot of instances. So for people flipping, I've never seen it where, oh my God, my buyers can't close because of financing. I've seen it, I can't sell because I'm looking for too much. I can't sell because the market's not great. But when you find a buyer, usually they're qualified and Lane can find them money. And even in terrible markets like Toronto's in right now in condos, if you qualify for a mortgage, you could still get CMHC financing up to 95%, even though that is likely to be CMHC, us as taxpayers, are likely to be underwater on that in 2 years from now. But because they use data and they're like, no, these borrowers are creditworthy, these borrowers can pay, it doesn't matter what the value does because they're creditworthy and they can pay. So going back to the financing side of Canadian real estate, it's very well supported.
Yeah, to Jesse's point, adding to that, not only do they do that, OSFI actually had to warn a couple of the big banks for lending far over 100% loan to value on properties by using 4 years ago blanket appraisals. They were lending, $900,000 on a 2-bedroom condo in Toronto when it was only worth 700, because when it was sold in 2022, it was worth 9, and they had a blanket appraisal. They got to the point where like, well, no one can buy these units off us. No one will be able to close, so we'll just give a blanket appraisal, because they were the ones that financed the bill too. So it's got to the point where our big banks are too big to fail. They're pretty bailed out by CMHC and the taxpayer. Good or bad, I'd argue there's a lot of bad points to this, but financial stability of the regular buyer won't be impacted directly. It won't impact the capacity for you to sell. It'll be more on the stuff that Jesse says about pricing too high.
Just a layer of Richard's question. I think the question is not really on the buying side, but really on the lending, on the flipper side, right?
Like to you, the buyer, as the flipper?
Yes.
Yeah.
I think it's a different criteria. You can speak of it better than me, but I think it's because when you have tighter markets, then I don't know how your criteria moves or something like that. Then it becomes more difficult for flippers to get shorter term duration of like
yeah, and
things like
okay,
that.
so
I think that's what
so for us financing the real estate investor, the flipper,
yeah.
our criteria never changes. Is the flipper going to be successful?
Okay.
That's our criteria.
So does that include like the credibility of the flipper? Like you always look for historical experience of the person and meeting the previous plans?
So in general, the way that we look at is the real estate investor going to be successful? Is we start with, is there profit in it? Yes or no? If yes, we move to the next question.
Okay.
And this, by the way, happens in 5 minutes most times. Can they execute? Tell us about your budget. Okay, budget looks real, looks good. Tell us about who's doing the work. Oh yeah, they know what they're doing. Great. Number 2 done. They're profitable, they can execute. Tell us about how you're going to afford this. Well, I have the cash. I have this line of credit. Oh, I have this house that you could blanket. If those 3 things are true, we're in. And that has never changed. Now, it can, if we don't have enough humans, which has happened. We've been so busy, we haven't had enough people to resource our real estate investors. We've had instances where we've grown so quick, we've run tight on capital. That's happened. Today, that isn't the case. We're well supported by a group of Canadian banks, plus a deep pool of shareholders, and we're actually overcapitalized. In theory, we have about $60 million too much shareholder money, which will reduce Lane and I, and even Larry's return next year.
60 million sitting.
Too much money. Not sitting there. We use a bank line of credit, and right now, basically, we're using 60 million too much of my money and not enough of the bank. We try to pay me 10%. We pay the bank today 4.75. That 5% delta is $3 million of cost that I'm going to incur unless we put the money out. But the only way we can do all this is if we put the money out safely. So that's long story short today. But even when we're out of money, Lane's got 10 super wealthy people that want to lend. If the things are true on are you profitable, can you execute, and do you have the money, there's no shortage of capital looking to back you. We do it at scale. We do it with the best service. We do it with the best cost, but there's people lined up to take our deals.
Obviously, you guys kind of specialize in this, but not everyone's heard of you. Obviously, short-term financing for projects like this is a fairly large market, so there's lots of other lenders in the space, I would imagine. Are your criteria, are your processes relatively different or unique compared to the average in your industry?
Yeah, the uniqueness we provide is this is our specialty. We know it inside and out. We're ensuring that, firstly, that our borrowers are going to be successful. Some of our competitors don't give a shit. You're going to borrow from them. They're going to make money. They're not going to lose. They're in. So that's something very unique about us. From a process standpoint, we do this extremely quick. We do our own values in-house. We have in-house legal, keep costs down. We move at the speed of business. Some can't.
Yeah, I can speak to that maybe a little more as a broker, but like the answer is yes, they're just better at this because they do it so quickly. They do have in-house legals. They will also, I mean, their turnaround time on these types of deals is fast because they have a really tight process because they do so much volume of this specific type of deal. They know how to see the holes. They know how to vet the clients. And the particular difference, though, is that they are because I've sent them a deal and they just said no, we're not doing this deal, but we like the client. Tell him to go find a better deal. His realtor's got him into a bad deal, which of course this was 12 years ago. I don't even know if you were at Calvert yet. I had to call a realtor, which fortunately I didn't know. So I was just like, hey, he can go buy another house. Like, what do you mean? Like, argue, like, that's stay in your lane. Tell your lender. And it's like, well, no, they want to know if they're making money. Well, we want to help them make money too. It's like, what? Don't you care that your client makes money? If he makes money in this one, he'll do another one. But there are some realtors out there that just don't care. They just want to close the deal. And they had equity in their house. They could have easily closed it. Calvert was not at risk as a lender, but they wouldn't lend on the deal because the client wasn't going to make money. So they were like, we'll do it. Please just find a better house. This is not a good flip. He won't make money on it. And that's my first experience with a private lender who was protected, but still wouldn't do the deal. And that is a difference between how they do it. But again, just the volume and the speed that they do it at. And again, they'll also, once we do 3, 4, 5 deals with them, like autopilot. It's like a blink. If they know how you do business, they'll glance at the deal. We don't have to get an appraiser out there. Their appraisals are better because they understand what they're doing. They see the flips. They see an appraiser has access to, sales. They have access to sales plus the costs that go into it, plus the actual, all the budgets and everything. So they know whether the money is actually being made or not. The rest of us don't have access to that kind of information. So when they give it, when they go into all that, they'll be able to return. It's within hours. If you have all the information, you could you could fund
all
like
you
in
need
2
is
days.
pictures of the property and a budget. And because we know you have the cash, we know you can execute. So literally, then we take those pictures, take the budget, say, okay, when it's done, here's how much it's worth. This is how we figure out if it's profitable. Here's how much it's worth. Back out all your costs, like financing, fees, realtor, property taxes. Ideally, like you as an entrepreneur get into the granularity of like snow removal. Some people miss a lot of things. We have a tool that helps you think all this through and says, are you truly going to be profitable? What's great about this story with Lane is he pushed back on the realtor. Because a lot of brokers will just say, oh, fuck it, Calvert's being a pain in the ass. I'm just going to go find the next lender, right? Like Lane cared about the client. Because like, unfortunately, it's the nature of being human. We're greedy naturally. And the realtor just wants to close the deal and the mortgage broker just wants to close the deal. So, which gets me into the most important piece of this is buying right. And to buy right, you need to know your numbers. Like, yes, rely on the realtor, but you need to understand what a comparable is. You need to understand how to take it and cross-reference so that you can come to your own value conclusion. These are what successful real estate investors do, is they're the entrepreneur. They know the numbers. I know every nook and cranny in my business, and because I care, because I'm passionate, and because it's my business. And that's where successful real estate investors need to operate. Yes, you could do one a year and make a little bit of money, by all means, but you still need to be able to understand what a good buy is and how to determine that yourself, how to be super confident yourself. The minute you're relying on any third party, you've lost. Like, you need to know that part of the business, and it's not that difficult. We have a tool to help you think through how to make adjustments. Realtors can give you amazing comparables. Realtors, if you say, give me all the sales in this neighborhood over the last 90 days, no problem, right? Like, yes, they will isolate ideally for the most likely comparable, like for like, but they're not, nobody, like even our valuations, while we're really good at it, they're not infallible. We miss things. And ideally your job as the entrepreneur, the business person is to back check and don't miss anything. So buying right is key. The profit is always in the purchase. Don't get lazy on purchasing and understanding that piece of the equation. Execute efficiently. Time equals money. Time equals money, it becomes a compounding issue when the market is on the downturn. It can act in your favor when the market's on an upturn, but now you're not an investor, you're a speculator. So figure out what your budget is, figure out what your plan is, and execute on time. Some of the real estate investors who do this at scale have a machine. They execute the same always. Some of our flippers that we work with in town, we can know what their projects are just by looking at them. They use the same materials, which are generic, broad. I call it builder's grade. Like when you go into a show home, builders are building for what the general market likes. And I could see from the cabinetry, oh, this is so-and-so's house. So being able to execute efficiently, talked about it earlier, stay in liquid markets. Even in a terrible market, I'm going to show you a quick case study of one that we just did in the GTA. Terrible market. But there's still pockets where there's a neighborhood, 300 houses, and there's only, for example, the way to calculate, an easy way to calculate inventory is you look at how many sold in the last month, right? And how much current inventory there is, and then you got your numbers. So 3 sold in the last month, there are 9 listings, you got 3 months of inventory. Now that's a small sample size, might not work perfect. Ideally you're looking at like 30 sales with 90 listings, but there's still pockets with hundreds of houses that are tight and desirable and liquid. And it's all about control processes and costs, be disciplined on projects. Another thing I talked about Ronaldo about, which is why he has a heads up than most of the people, is he knows how not to get screwed. And not to get screwed might just be like, rather than buying a $3,000 countertop, you could get the same builder's grade countertop for $1,000. That's $2,000 in your jeans. When he gets a quote for electrical work, he could say, oh, this seems off, and go shop it to the next guy. Or better yet, for like easy lighting, he doesn't need an electrician. He's in there swinging the hammer, paint on his jeans. Those are, at the beginning you need to do that. I hate to break it to you guys. Even if you have the best contractor in the world, you're losing out on margin. And you're losing out on the opportunity to learn, more importantly, what works and what doesn't. This is not flipping. To be really successful is not passive. It's you're in there.
Hyperactive.
Yeah.
I do want to clarify something, because we often say that the opposite of what Jesse's saying right now, when it's like you make money on the buy. And I will throw it into our conversations, like, unless you're flipping, but I don't flip, I don't like flipping. It is a full-time job. You can do it as a full-time job. In a great market, you can flip and make some money, but again, that's because the market made you the money. But when we talk about buying, we're like, no, go buy a good house. You got to overpay 10 grand for it, overpay 10 grand for it. You can own it for 20 years, that good house, the good parking, the extra suite, the triple garage, that's going to make up for overpaying 10 grand. So when you're buying for the long term, it's about the house, not the price. The exact opposite of what Jesse's talking about, because he's talking about flipping. It's not a passive income, it's an active income.
Money on the buy, but it's not so much about the deal.
That's not the pure determining factor like flipping.
Exactly.
And I'd layer on, I completely agree. We have a lot of clients that buy, renovate, rent, refinance, repeat. And they care about cash flow. So if it pencils, and they're like, if the deal pencils and it's going to cash flow once they do this, it doesn't really matter what they buy it for, because it's cash flowing. Maybe they buy it for 500, put 30 into it, and it's only worth 530. Doesn't matter, because they're buying something that pencils, and you need to put the 30 into it to get it to where it's going to be able to rent for that pencil. So Lane is exactly right on long-term holds, and we work both ends of the spectrum. We do a lot of work with pure flippers, but also a lot of work with real estate investors who hold. And a lot of them do both. Like some are like, fuck, I love this property, it pencils. I don't want to have to do another 3 flips. I'm gonna sit here and hold this. And then they're like, oh, the market's right. I got a high mark, my price is appreciated. I can buy a bunch, I'm gonna start liquidating some of these, the burrs. So, yes.
Elaine and I's accidental flips were always supposed to be burrs that, sometimes it's better to sell. So.
Yo, I just made 60 grand, let's sell.
Yeah, it was, what did we make of that? Like
200 net.
200,
Yeah.
200 net in less than 6 months from purchase to sale, yeah. Yeah, that doesn't happen. I tell people all the time, I don't flip, I hate flipping, don't flip, and then I flipped.
So, like I'm coming from the blue collar side of all this, what does that mean in pencils?
Pencils is just like when you run, and we'll get into how you analyze these deals. But when I talk about a flip, penciling is, okay, I've looked at my purchase. I know my after repaired value. I brought in all my budget. I brought in my financing costs, the legal costs, the realtor costs, and the profit is there where I'm not buying a job. Again, we talked about this earlier. Ronaldo can do a job and he does cost plus 20%. So 50,000, he'll make 10 grand. So if he's gonna do that same amount of work, he better be making more than 10 grand, not buying a job. And he's like, yeah, this pencils, I'm in. So that's what it pencils looks like. So with the burr, where your long-term goal is to buy it, renovate it, rent it, and refinance it with the bank loan. Pencil means I'm going to be able to rent this for what I think I can rent it for, and it's going to be able to cash flow for what I needed to cash flow for. They're not nearly as motivated with how much value you're adding. Now, fuck, if you're adding $200,000 of value, amazing. Like, you could do whatever you want with this thing, you're in the green. And Lane chose to sell it and maybe do the next one.
I mean, because we felt that we could go buy better long-term rental properties with that money, with that capital that would give us better long-term return in this particular case. But had we not been able to do that, it actually involved splitting a title, which was what gave us the good part of that jump. But had we not, we know what it would rent for with some confidence because we had some identical units down the street. And it worked, but yeah, so it's like, yeah, penciling in a flip means you make profit when you sell enough to replace it, you're not buying a job. Very important to consider that. A lot of people don't, especially in the beginning. And but yeah, penciling for a rental, like I bought properties where I bought them for 500, put 120 in, couldn't sell them for 570. Like I'm 50 grand upside down if I was to sell it. I didn't care. I was cash flowed like mad. Like they're cash flowing properties, and I'm gonna own it forever. So that's how I look at most of mine. So penciling is different depending on what you're considering.
Yeah, and it's really critical. Like those are two very different strategies: flipping for profit versus renting long term. Anything? Perfect. So basically, the antithesis of what we just talked about, why things fail: overpaying. When you overpay for a flip, compresses margin, right away you're off on the wrong foot. And penciling sounds easy, but this is a critical part. This is the most critical thing you put into your penciling, which is how much am I buying it for? What is my budget? And how much it's gonna be worth when it's done. Budget overruns kill deals in any market. They usually create delays as well. Overestimating the after repair value. This is a tricky thing to do. Going back to Lane, where we provide a lot of value is we do a ton of these. We know how to value after repaired. The average appraiser that's doing, let's say they're doing, I think they can do like 3 a day these days. And they work for, what do you work for? 200 days, so they're doing 600. Yep. In the year, they might see 10 that they're being asked to renovate a property after, to value a property after renovations. So it's rare. Where we're doing, for every deal we see, for every 10 deals we see, we're funding 3.3 of them. So we are doing hundreds and hundreds of after repaired values a year.
And then you get to see how good your judgment is because you follow it through the appraiser.
We get an instant feedback
He's gone. He never looks at that property again. He doesn't care. They don't make enough money on a deal to even follow it or be curious, even be curious enough to care on those. They want to know every detail because it's important to their business model.
So poor timelines, again, delaying. Delaying could be because you missed on project management. Could be because you missed on where you're sourcing your materials from. Could be because you I mispriced it and now it's sitting on the market forever. But these things really impact profitability.
Permitting.
Pardon me?
The permits.
Permits, yeah.
With the boss.
Yeah, permits are pretty good in Calgary for the most part. Like I haven't, like where do you need a permit for a flip these days? Maybe if you're suiting,
Yeah.
but it's like,
That's why a lot of people do legal suites and flips, is to skip the permitting process, because that is the one timeline is development permit.
yeah,
Can be slow, but to your point, you rarely need building permit.
yeah.
If you're not changing the structure, which most likely will.
Most don't. Like what I talked about, the bread and butter, you're not needing a DP or BP. Yeah, yeah. Too many projects. We've seen a lot of really great real estate investors who executed one at a time. They were amazing at executing, and then they weren't amazing at project managing, because once you get into multiple, now you are dealing with actual project management, aligning trades, aligning materials, moving money around. Like it's a bit of a it is a different beast. And some have scaled really well, but some they're just better off to do one at a time, two at a time, because they just don't have that process management. Now, luckily today in the world of AI, there's so many great tools that as long as you're diligent, you can enter this in and it can literally do the project management for you, whether you like Gantt charts or some other thing to help you with this. It can literally alert you, hey, we should be doing this today. Hey, hire this today. Hey, make this go today. Hey, buy this material today. It's a lot easier to project manage today than it ever has been. As well as process. Like process and project management to me are two in the same. Are you buttoned up? Do you know where you're getting materials from? Do you know when your trades are going to be there? Do you have your realtor? Do you have your broker? Do you have your lender? Where are you sourcing your comparables from? Like when a lot of buying right is about when a deal comes, being able to quickly move through due diligence and close on it, which is another thing, which when Lane says why we move so fast, like we can literally make a decision today. It's because something came on the market right now. It's a great deal. The faster you can put an offer in, the better. And you need process to be able to do that. If you're sitting on it for 24 hours and it's a good deal, there's 10 other people that are snapping that thing up. So we talked about how hard it is to buy right. You can decrease that friction by having a good process to analyze your deal and move quickly, which we have tools for that. And then overbuilding is another thing. Like when I talk about builder's grade, I mean building for the neighborhood. Sometimes flippers get in and especially new ones, get a little too cute. Like, oh, I would love this color. Well, no, like less is more. Go vanilla. Putting a steam shower in a $600,000 single family home. A steam shower costs, I just quoted one out. I'm building a house and I don't think I'm putting a steam shower. My wife may have other ideas for me, but like, I think they're like it's $3,500 plus a bunch of stuff. You can't put that in a $600,000 house, even though you would love it. You don't do that. Same as like, as I'm building this house, I'm shocked. Like that light might cost $200. That light might cost 20 grand. Buy it, that costs $200 to put in your flips. Just stuff like that. Like, yeah, the sales guy's gonna try to sell me the $20,000 one, but no. As long as it's not gonna fall apart in the next 5 years, I'm buying the $200 one. So like examples like that, even cabinetry, like IKEA kitchens look great. I have an IKEA kitchen right now in my house. It's fine. And this is what the buyer pool wants. When you go into a house it is very hard to tell if it's worth $200 a square foot, which I think you could still do. Like if you're really grinding, you could do this, or $1,000 a square foot, like a Rockwood, nicest home in Calgary. Most buyers cannot tell the difference. Yeah, the realtor's gonna try to sell them on all the nonsense, these faucets and this and that. Doesn't matter to a buyer.
Yeah, if you've ever been to somebody's house that did a renovation, overspent on it, the only reason you know is because they tell you. They will tell you, look, I paid $2,000 for this bathroom faucet. Look at this. I had a guy showing me it. He's like, watch, as soon as I turn the water off, it stops. And I'm like, that's how faucets work. But he doesn't even drip though. Doesn't even drip. And I'm like, I've never noticed mine dripping. I've never thought of that. And then he told me a couple of times about how he spent $12,000 on a really ugly piece of granite that was about like this big on an island in a house in Riverbend on a court. Like it was not a nice particular, but he told me about everything he spent and how much he spent on all this stuff because.
Whereas I will be lamenting all those shitty decisions that we make.
Yeah,
I'll be like, can you believe this? I could have bought this same toilet for $350 and somehow I got scammed into $800, which is the case. So buy sharp. Like all those details matter. You're a real estate investor, as an entrepreneur. Let's just go with it.
You could go too cheap to where
don't go too cheap.
Yeah,
where it's falling apart, it's crap. But for like a Moen faucet, it functions the same as the Italian faucet. It does. and like nickel finish, I didn't know this. Nickel finish is the cheapest. People are fine with nickel, like the brushed nickel, versus like the rose gold. Don't go with the rose gold. You're not going to get the money out of it, even though it might look a little bit nicer to you. The buyer is not going to pay an extra $300 per tap in the purchase price. So what successful investors do differently? We talked about this. They stay disciplined in hot markets. While emotion drives other, they're back testing it, and they're saying, how much did I really make in profit? How much was the market versus how much was me? And they're not getting caught up in looking at the end number. They're getting caught up in really back testing how much they made. And that doesn't take that long, right? Like just sitting there, sober second thought, okay, how much did I really make? Once you have done one, it's 15 minutes to understand. The market went up 10%. 5% in this 6-month period. That's $30,000 on the $500,000 sale. Cut that out. That wasn't profit, that was luck. And really think about it. They stay active but not selective in downturns. Stay active but selective. So there is absolutely still money to be made in downturns. And usually it's easier to buy because that seller psychology, there's more on the market. Yes, you got to be selective. Yes, you got to buy in the right market. But there's better buys in a poor market. Focus on repeatability over one-off wins. So, Lane's $200,000 example, what did he do that's repeatable and he should continue doing versus what did he do that was just luck? And continue doing that and iterating on what worked versus being like, this was repeatable and defensible versus luck. Because he might have did something where he got lucky, and it's important to dissect that and understand the difference between those two. And then you adapt strategy, not your principles. So your principles of staying disciplined, buying right, executing right. Yes, you can adapt your strategy. Maybe you're so used to buying in like the Bonavista Willow Park areas. Market's not great. We're going to move over to market. You're so used to buying townhouses. Townhouses are oversupplied. We're going to get in a single family. We don't like condos, so I don't like getting into condos, but we've seen successful flips in condos. Maybe you're a condo flipper and you move over into another product type or another area of town. So you keep your principles and you adapt strategy. Maybe you do a BRRRR. Maybe you buy something long term because it's cash flowing. That's what really successful investors do. I won't go too long onto this because I think I am going long in general, but this is just the execution gap. You fall in love with the pencil, the numbers, not the deal, right? A lot of times you do all this work, you're so excited about this because you're pot committed psychologically. You got to get what you got to get most excited about is the spreadsheet, and the after repaired value and the profit, not the idea of doing the next deal. So on paper, you plan your time, your costs, how you're going to coordinate, what the results is going to be. And then if you have a gap between that, like if you're over optimistic, you want to do everything on a realistic to pessimistic basis, because you can change numbers dramatically if you move it 2 months. I can execute this in 2 months where really it's going to take you 3. I can sell it in 2 months, really it's going to take you 3. I can do it for 40 grand, really it's going to do 50. On timing, I can coordinate all these people, really they're going to take weight. Like I would love it if my plumber was in, my painter was in, my carpenter was in, and my house was finished in 6 months. And in theory, you could finish a house in 6 months. I can't. I'm not a builder, and I'm not going to pay my builder to do that coordination. I could wait a year. And then, because the more optimistic you get, things can deteriorate really quickly, where all of a sudden you've painted a rosier picture than it is. So where you fall in love with the numbers, you get really realistic, bordering on pessimistic, and then you're like, oh my God, no matter what, I'm making money here. And yeah, that's hard. Yeah, you're gonna say no to more deals than you're saying yes to, but you're gonna be long-term successful. Maybe I'll stop for questions, if you have any.
What areas do you find, like right now, for those who are actively flipping, where are you finding, like in these downturns, and maybe we're in the beginning part of a downturn. I think we still got 18 months to go. But where do you find, like your investors in past cycles, where are the ones, like the ones that you probably have a handful in mind that you think of that do this, where do they gravitate to in a market like this? Do they shift to a different type of property? Do they do
in general,
lower end rental stuff, which may not be good this time because of all the MLI Select product?
Yeah.
Do they do, because that might actually change from the last ones, would it be more of mid to high end range?
In general, they're
mid-range?
taking a holistic view of the market, and they're data geeks.
Okay.
So they're looking at where is inventory, where is there tightness in the market, where are things selling actively, and they're moving around there. We talked about earlier, right now, the sweet spot, if something comes up that's priced right, single family, 600 to 900 grand, that is moving. So where are those markets right now? Acadia,
Probably North Central or
North Central.
Glenmorgan, Glendale.
Yeah. For a long time, the Northeast, like the $300,000 to $400,000 properties in the Northeast were phenomenal. But I've seen since they've built out with newer housing stock, and a lot of it being like that multifamily MLI Select, now renters can get in at a decent price. And so now, rather than buying, more people are looking to rent. So that's kind of deteriorated that model.
Part of the market suffered more.
Pardon?
That part of the market suffered more.
Yeah.
More than other parts of the city.
And that was like where from like 2014 to 22, that was bread and butter for a handful of our flippers that would do 10 a year. And now they've shifted. One guy, like exact opposite, he's crushing it in that Willow Park Bonavista Vista, buying for just under $1 million. Very capable renovator, renovating for 200. Like at first we're like, what? Does this guy, like, can he do this? Because he went from buying 300 grand and renovating for 50 to buying for just under $1 million and renovating for $250,000. And he's never seen bigger margins. So he was able to very successfully move, and we paid about, again, going back to the success of the client, we like really talked him through it, and he gave us confidence, and we're like, yeah, let's go. And now, at first, he had a successful, and he was ready to scale more, and we're like, we're not quite ready for that. We talk about our appetite. And he went and found he's like, no, I know this, I can do this. And to his credit, he went and found another lender, showed us, gave us even more confidence, and we're like, okay, the checkbook is open, let's go. so yeah, like these, the really long-term people in the business are just data geeks, and they're calling the realtors all the time and like just talking about ideas. Like, hey, here's what I'm seeing in the numbers. Are you seeing this on the ground? Yeah, they're just moving to where the opportunities are. And to your point, sometimes the opportunity is in holding it long-term and burring. Right now, I don't think that's a sound play because of all the money that Larry's lending into the market at CMHC.
Single-handedly destroying the Calgary rental market.
Well, no. Larry's creating affordability, which is the Alberta advantage. So you got to think.
There we go.
Now that we're doing a lot of business in Ontario, and we're hiring in Ontario, and I know Ontario. I'm from Ontario originally, but I know it deeper. This affordability thing is a real issue, and the fact that you can have a young couple or a young individual move to Calgary and rent something decent for under $2,000 is unheard of. Never mind rent the 1,300 square foot that I was lamenting for my family. Not great for my family, but husband and wife in like 10 to 15 minutes away from downtown for 2,300. That is amazing. Not for the landlord investor, but amazing for our city. That's driving growth in our city, which will eventually create the economic growth, the GDP, which will eventually increase housing prices. Everything goes in cycles. Well done, Larry. I pick on Larry. Larry's wife and I work together. Yeah. So if we're fortunate enough to get a deal from you through Lane, hopefully you'll get his wife, because she's one of the best. She knows this stuff better than I do. From an actual like putting it into practice and making sure you have the right deal. I used to know this stuff, maybe as good as her, but I don't get to underwrite as much anymore. I don't get to underwrite at all. So how real estate investors improve, again, conservative assumptions, stress testing your cost and what you think the after repaired value is, which protects your downside. You got your plan in detail. Scope it out in full. It's so easy to scope things out now. You just literally sit there in front of whatever machine you're using, ChatGPT, Claude, Grok, whatever, and just start talking to it. Like literally talking this through it, maybe feeding it your comparables. You are now the master of minds. It's so much easier to do this work than it's ever been. And you could ask it, is this a realistic timeline for Calgary, Alberta, for this material I'm using? And it'll not perfect every time, but it'll be a great resource for you, for this community. Plan for contingencies, identify what the critical paths are. You want to build the right team, contractors, brokers, realtors, lawyers, lenders. Like a lawyer can sit on a file for 5 days and cost right now a real estate transaction is dirt cheap in Alberta. Like $1,000, maybe less.
Yeah.
So lawyer A could charge 1,000, lawyer B, they're all 1,000. Lawyer A has processes, understands what you need, and can move it in a day. Lawyer B could sit on it for a week and jam you up. And you're communicating your expectations. Like the last thing that your realtor wants to do is just be your assistant. Like you got to send them some business. Maybe not every deal, will be theirs, but in theory, you want every deal to be theirs. You want to build that super team. Maybe on the purchase, you're going to buy from a wholesaler, you're going to buy off market. That's fine, because they're going to get the sale. But if you're going to ask them to do a shitload of work and pull comps and be your sounding board, you better be making it fair to them. Like, they're not free. They're going to ditch you. I would fire you. Actively manage. Ideally, at the beginning you're in there, swinging the hammer, getting paint on your jeans. But even when you're not, like the best people that do it at scale, they have a regular regime for check-in. They know where their projects are at. They know where it should be at. They know who's going to be on a site. You're going to go visit that site. Maybe you have an assistant that's going to go visit the site, but you've set them up with the process. Like, everything has to be tight. You're tracking the progress and plan, addressing issues early, keep moving it forward. Cost control, 3 bids, 1 buy are great, especially when you're using contractors, but also vetting the contractor. Like, doing the due diligence, just because the guy's saying 30 grand, okay, what materials are you using? What's your process? Like, asking those questions. And again, the machine is so good for that. Like, here's the project that I'm doing. Here's who I am planning to use. Go scour the web, give me everything you have beyond Google reviews on that. Okay, now what are the important questions I ask? Okay, now what contract should I get? Okay, I got a contract. Hey, what's missing to protect myself? And that's all there for you now. Like, you could be a lawyer, a contractor, like, you can pull in all this expertise to your advantage. And then again, back test. Measure and refine. Review results, capture, learn lessons, improve process. Don't pat yourself when you make money. Absolutely, that's amazing. But make sure that you understood where you actually made the money, where the market made you the money, and continue to refine that process. Here I talk a little bit about liquidity. Again, it's all about buying right and in the right market. So the best, broad market appeal, mid to lower half of the market. Mid to lower half of the market is great because what's amazing about housing is it's just a human need. And when the market is cratering, people still need a place to sleep. Like, back in the biggest downturn I've been in, well, I guess this 30% drawdown in Ontario was the biggest, but even during the global financial crisis where Alberta got hit really hard, what happened was there was a ton of price deterioration on high end, very little on low end. And that protects your downside. Now, if you're only going to be in and out of it for 6 months, you're very likely to get wiped out in that period. Like, through this Ontario downturn, yes, it's been about 30% from peak to trough. Call it trough being today, peak being April of 22. We're 4 years in. So on average, we're, 9% a year. Like, it's, when you're moving quick, it's hard to really get completely negatively impacted by the market. Where you have low liquidity, high-end homes, unique properties, also unique markets. Like, a lot of people, especially early on, will go to like Timbuktu. And I'll call Timbuktu Strathmore. Strathmore is like, not everybody wants to live in Strathmore. You could probably find a deal that pencils in Strathmore, but fuck, that buyer pool is small. And then the further out you go from Strathmore, it's even smaller. And you might be able to convince yourself, well, people will commute from Strathmore. Yeah, they will, but not everybody. So the more rural, and especially rural, like rural is really tough. Buy in markets where there's liquidity, especially at the beginning. We have experts that know Strathmore inside and out, and they have it dialed, but they're snapping that stuff up. So stick with markets that have a large buying pool and in turn a lot of liquidity.
And property types, you referred to that as uniqueness before, but it's like, if you drop the price 5%, will it sell the next day? And if it's a cookie cutter house in any neighborhood in Calgary, and you've priced it right, and then you need to fire sale the next day, you drop it 5%, you're gonna have competing offers. If you got a big house with a pool or the unique house of what other price or character or something, or its location, you drop the price by 20%, it still might not sell the next day because nobody's looking for it.
Yeah, like ideally you have like 2 or 3 direct comparables, right? Like, okay, these have sold and these are listed. And then you get really sharp on price if you can. Like, maybe you get greedy and try to sell in the middle, which might take more time. But if you're like, if I see all these at 620 to 630, I'm gonna list at 625, might be harder to sell. I'm gonna list at 618, you come in new and the hottest, the realtors, how easy is it to sell that property?
A lot easier.
Never mind, shit, if I go to 600, I know this is gonna sell. Like, having that amount of confidence when you're doing your due diligence and penciling, that is where, like, whereas like, oh my God, I got this $3 million house, it's got a pool, maybe somebody wants it, but there's this 2.5, what is it really worth? That is not confidence that you want to be able to execute on. Yeah, we kind of talked about this at length, nothing new here. Changes, margins, timelines, demand. What never does, discipline, execution, and fundamentals. Of course, the market will provide pros and cons in every market. It's easier to buy in a down market, easier to sell in an up market. You're getting margin expansion in an up market. You're getting margin depreciation in a down market. There's pros and cons to everything, but what never changes is buying, executing, selling, and the fundamentals on what to look for in the property.
Probably get close to wrap up. So yeah, if you got,
okay, I'll talk a little bit about. I've gone into it, but where we really add value is these fundamental pieces where we validate the purchase price and your after repaired value. Like, we do that from a point of care, not just for our capital, but for the client and the long-term success of the client. That is a huge value add. Budget, Ronaldo knows his budget inside and out, great, but we'll still pressure test that. Like, Melissa will say, this doesn't make sense, and here's why. Exit assumptions, so that after repair value, which is the critical thing, we back test that. And then timeline, we'll give updates, we'll provide that. A lot don't. The people our super investors, the ones that are on autopilot, they don't need any of this except for speed and certainty. And that's what we provide them. Speed and certainty. That we're gonna be able to make a decision quick, fund quick, and when we say we're gonna fund, we fund. Every now and then we'll call them out and be like, what's going on here? And they usually have better answers than we do. I got this. Okay, couple quick case studies. And then Lane could give you all the information about how our products work and our pricing and all that. And again, this will all be shared. So here is a good one just recently in Scarborough. Scarborough is, from a market overall, brutal. Yet this property was $100,000 net profit, where they bought it for $637,000. We are able to lend with as little as 10 grand down. So we lent them in a shit market. We talk about how lenders tighten up. We lent them more than purchase price after our fees. We lent them $627,000 plus call it the fee would have been 2%. So for that, because we're taking on that outside risk, unique product, we charge 17.25 for that deal. Interest rate.
For first position, it's 17.25 on that Scarborough.
With 10 grand down. 6 months, fully open, interest-only payments. So they were in and out of this in 3.5 months, right? So they really paid us annualized, call it less than a third. So they actually paid us like 5.25%. But if they held it for the year, they would have paid us 17.25, which is why the timing is so important.
Yes.
But again, these are entrepreneurs. They saw the money. they knew they were going to be profitable. When they penciled it, they're just like, no, 10 grand works for me. These guys did it at scale, I think. So they had other projects on the go. They found this amazing opportunity rather than, we can lend them at 6.9% if they put 30% down, but they didn't want to put another 200 grand down because they're holding some available for the next opportunity. And they were able to make net after everything 100 grand in a brutal market with the 17.25 rate.
Plus 2% lenders.
Yeah, and 100 grand is the net. And I'll quickly show you. I won't go into these, but here's a couple quick examples of deals that we've done. Deals that we did in July of 25, all at higher rates. Net profit after sale price, various renovations. Like this guy's that's probably our Willow Park guy, I suspect. This is probably northeast. Like where are you getting a single family at 450 these days?
Yeah,
So all different strategies. This one took a year because of the high renos. Maybe he ran into time delays. This flip 3 here, he was in and out. Like he executed on a $70,000 reno and in and out in a month. That's crazy. So just showing different examples of how flippers operate. But then in terms of, I won't go into this, in terms of how you analyze profitability. So we open source this sheet, which shows you.
It's on your website?
Yeah, the critical assumptions are, the most important things to put in, how long is it gonna take you to renovate? What's your rental cost? How much are you putting in? And then the down payment will dictate what your cost is. This guy put in 150 grand on 500, so that's 30%, so they got 799 fully open, 2.5, and this includes broker. And it penciled that net, like after everything. We tell them, like legal costs are in here, realtor cost, everything, almost 69K. And yes, it's on our website. Yes, Lane will give it to you, but if you have questions, you could call Melissa and she'll walk you through it. Melissa's already busy. She's still on mat leave, but she's busy.
So just out of curiosity, when you say they put like 10 grand down on a $790,000 house, so are they borrowing against their own property? Like
No. They are profitable.
So it's just,
They know how to execute,
okay.
and they had the capital to
First time
execute.
borrowers, those are
No, they might. Well, this wouldn't have been a first time, but we will lend 10 grand down to first time borrowers. Profitable, execute, have the capital. So in that example, I think the rental cost was 70K. So like here, so in this example, it will show them how much cash they need. So he's doing the 150 down, right? They have the renovation of 60. They have they have carrying cost of 12. All that's factored into cash needed. So you need to show us that you have 227K for this one. The 10 grand down one, 10 grand down, carrying costs are going to be high because the 17.25 I'm borrowing so much. But let's say it netted out to 90. Show us that you have 90. And 90 could be cash in a bank, line of credit, credit cards. Like we have first time investors that are young, sharp tradespeople, and we will gladly support them and take that risk.
And crazy.
Well, is it crazy? If your numbers are super tight and you've back tested this and we back test it and you're gonna make 70 grand, I'm in.
Why not?
And we like from a historic loan losses, again, we do a lot of this. We are a financial institution. We have good data on this. On flips with 10 grand down, they are, from a historical loan losses and arrears, less risky than we call it a term loan, where a borrower is borrowing for a longer term with 25% down. We see less arrears and less losses with our flip product than any product other than a true bridge, where we're bridging a purchase and sale. We've never seen a loss on those, luckily. So we'll do all those. But this is well, it can seem risky. If you're tight on everything, you've de-risked it for yourself.
I have seen this table before. What is the minimum profit you consider maybe acceptable? Let's say.
I don't want you buying a job. I don't want you buying a job.
Exactly.
So-
let's say a
so-
property of 500 grand at the purchase.
So for
Selling over 600. What do you think might be the minimum acceptable profit as a flipper I should get?
It's a great question. So let's walk this through. So on this, the renovation costs is $60K. So if you're just doing your normal day-to-day and making 20% on that, that's $12K, right?
Exactly.
Okay, so this job is going to take you the same amount of time except for coordinating everything, which is significant. Now you have more capital at risk, so certainly it's got to be way more than 12. Is it 30? Our underwriter would talk to you about that. Like, hey, if everything is tight and you're pessimistic and 30 is your worst case, then it's probably worth the risk. For this one, I would suspect it's definitely worth this for you. Again, provided you're tight on your numbers and you're like, I would suspect for this, this would have been written to that likely to pessimistic approach. So it all depends on the individual, but profit, the way we look at it is, are you buying yourself a job? Is the risk not worth the return? So for this, I would say if it was 30, it probably wouldn't be worth it. Or that would be borderline. But this, from your perspective, because you're doing what you normally do, yet making 5x, do it.
Do you find most people are finding these deals on market as soon as they come on, or older listings?
Everywhere. As soon as they come on, buy your house for cash, wholesalers, running around neighborhoods, door knocking and putting flyers in. I know the realtor, I don't know if you guys care, because you guys want like a true flipper, long term, they see it as that relationship and selling long term. Of course, they would love to source every single purchase, but that's not the nature of the game. The nature of the game is, yes, as soon as it hits MLS, go.
Or multiple days on market.
Multiple days. The wholesaler who's running around doing bird dogging that deal for you, then charging a bit of a margin. Door knocking, flyers.
The majority are on market. Or
Optimizing Google, like where you're like, optimize for, because people that sell these houses for the most part don't want the general market in there, right? Like they're hoarder houses, they're older, they are not wanting to tell people, they're not wanting to air their dirty laundry. This is not a great house. So those are wholesalers and flyers and optimizing Google, where people are up at night. How do I sell this without getting a realtor to show people around my house? And that's like, how do I sell for cash? And then his advertisement will come up, or your advertisement will come up, whatever it is. So that's where those are found.
Incorrect listings too. You see that sometimes.
Direct,
Incorrect listings.
incorrect.
Yeah, sometimes the information drawn
Is,
is things like that.
misrepresentations.
Like a shitty realtor.
Yeah. No, that's it.
Hey, I'm not painting. I'm using the same disclaimer language earlier.
Yeah, but that is where
An inexperienced realtor.
Yeah, that's where we found our one flip and some other deals too. It's like, yeah, he's got this one listed wrong, and so it's not showing up in the right searches, or they've just got it wrong in terms of the listing, and nobody, so people
Where
are just passing
Anthony
by it.
just became a realtor, convinced his mom to give him the listing, and he fucked it up.
Yeah.
Take advantage of that.
Yeah.
Jess, do you lend on third position or not?
Give me an example.
Like, for example, you have first position.
Yeah, but give me an example. We'll do anything as long as it makes sense.
Yeah, because usually the third position it's way beyond the property value.
Well, we'll never do that. That's crazy.
But
we're
it could
pretty
be
smart. We're pretty good at what we do.
Could be 200 on a first, 100 on a second on a $800,000 house.
Like for example, maybe you've worked directly with the seller. and you're buying it for 500 grand. And you think that's a good purchase. And you've convinced them to do a vendor take back, it's called. This is where you get really creative.
Yes.
Don't start with that, just find the property and go. And they're gonna take a vendor take back of 200.
Yeah.
And then they found, who would be my second? Like, why would you not come to me for a second?
Well, maybe they have a first that you could assume, and they'll do.
Okay, I love that. I love that. You assume the first from TD at 200.
2.1.
They did a vendor take
yeah.
back at 100, and they're charging lower than market rate,
Yep.
5%. 100% will do third. As long as you're going to be profitable, we're not underwater.
Okay.
We're not in the business to lend on underwater.
Okay.
Nobody should be. You should never be asking people to lend if you're underwater.
Okay. The other question that I have is, do you require ARV from external appraisers?
We do all that ourselves. Yeah. The only time we'll need a third-party appraisal is if it's high-end, over $1.5 million, multifamily. Just because we don't have that deep expertise, right? Like we still value third-party inputs on stuff where we don't have super deep expertise on. Now we'll sometimes disagree, but for the most part, we value that third-party validation when it's outside of our scope.
Okay. Do you require building condition report?
No, the shittier the property, the better. But what we will say is, have you walked the property? Do you have foundation issues? Like, we get this business inside and out, but we want to make sure you've looked at all the potential issues. Like, hey, this sewer line might not work. That's going to be 25 grand. Have you thought about that? Have you got it scoped? If you haven't, that could make or break your profit. Go get it scoped for 500 bucks. Like, we're not going to let you get into trouble because of you're trying to cut corners. So we do not need a builder, whatever you're referring to, but we will say, have you made sure? Are you confident that you're not buying a problem?
So building condition report is basically an inspection for commercial. How active are you in commercial?
For multifamily, pretty active.
Multifamily, yes.
Commercial,
yeah.
no.
Yeah, okay.
Like we have enough volume. We have our goal, similar to any business person's goal, is you stick with what you know and you execute the hell out of that. And then when you see diminishing returns, maybe move on to the next thing, whether it be commercial. We would go to BC, for example. We would just execute this in BC. Right now, we believe we have a long runway in Ontario. But we wouldn't go to commercial. We wouldn't go to land development. We don't know that. There's guys that know that way better than us. And I think that holds true for any entrepreneur. Lane knows mortgages inside and out. Maybe he goes into commercial mortgage brokering. Probably the parallel wouldn't be to go into a realtor or an appraiser. Maybe he could.
I do. It's like anything. You find a mortgage broker, realtor, specialize, condo specialist, investor specialist, whatever, or a refinance specialist, divorce specialist. And you're like, you can't be a specialist in 9 things. That means you're a generalist. Like, it's like you kind of have to pick a lane, which is, I mean, that's a good answer. They don't know commercial. Why? Because it's sexy. And I think one of the best takeaways that you said is, like, go to the spreadsheet. Don't get me excited about the property. Get me excited about the sexy spreadsheet. Like, that's who you want to be a nerd so much that you're like, show it off to only people in this room because no one else will get it. Be like, if you could drive by your property and brag about it to your friends, you're focused on the wrong thing and you put yourself at risk. If you're showing them your dorky friends, your spreadsheet, that's when you know you've got the right mindset for
I found
investing.
something in the real estate market that I think is unique, and I'm really excited to take advantage of it. Like on commercial, for example, our shareholder group is huge. Lane and I have a common buddy. We'll call him Anthony, and he loves real estate investing. He invests in our fund. He knows commercial really well. When I see a commercial deal from a broker or or somebody comes direct to us, I'll say, hey, go talk to Anthony. He knows this. This is for sure a private deal. You're bang on there. It's just not us. Here's your guy, because he knows it inside and out. Yes, we can make money at it, but I don't know it. I'm going to create friction, maybe risk. I'm not the right guy for it. We're not the right team for it. Great question.
Sorry, one question. This might be getting a little too narrow. In terms of, kind of the risk components that you might be thinking, okay, that rules out a good investment. I'm thinking in terms of foreclosures. They sometimes come along with a tenant or, the owner
Yep.
still there who becomes your property when you get, or it becomes your problem when you purchase a property. How do you see those kind of situations?
Yeah, foreclosures can be great. The risk is you're buying them as is, where is. So there's no representations or warranties. So when you buy a foreclosure, the current owner, the day before you take possession, could fuck up the house, and that's yours. And that's a bit of a risk. They're usually discounted versus the market. So for example, sometimes our borrowers aren't always successful, and they can't, it's not really with flips, but like where they can't afford the mortgage. And what we always advise them is just sell it for what it's worth. We're gonna take our loss, it is what it is. You're gonna take yours, it is what it is, but sell it on the market for what it's worth, or else you'll get discounted at least 10%, at least. And plus a $10,000 legal bill, and we want to avoid that. So we do that because of my roundabout way for the story is because the market will discount that. And is that an appropriate discount? Usually, but sometimes it's like, they really messed up. Like there's been horror stories where they will flush cement down the toilet, and now you got to redo all the plumbing. And this is the risk that you're taking on.
But how do you see that risk as the lender?
We see that risk and we say, okay, are you getting the appropriate discount? So if it's a like for like and it's just a 10% discount, probably not enough. But if you're coming in hard, fast, solving the problem, then we've seen borrowers be successful at it, but it's not a silver bullet. Some people love to say, oh, you're getting this awesome deal in foreclosures. The market's the invisible hand of the market is pretty good at pricing risk. And that 10% discount is usually accurate because on the whole, you're not getting what you've toured during before the sale. And you're buying as is, where is, no representations or warranties. So you can go in the house and it could be totally a different beast than what you thought. And then tenants are a different thing. I think the Alberta tenant law is you don't assume the tenants in Alberta.
Yeah.
You do?
Oh, yeah.
Yeah, you do.
Okay, so now you got a tenant. So now you got a tenant. So now you got to figure out, that's another risk. You don't want to assume a tenant unless you've already somehow talked to them and got a plan in place, cash for keys or whatever. In Ontario, it's an even bigger disaster. It is crazy how much rights tenants have in Ontario, and we've learned that through some foreclosures. And it's just a risk that you got to manage. And it's going to significantly impact your timelines. So you probably want to take those on once you've become a seasoned vet.
Not a beginner.
I would say. Yeah, good question.
Thank you, Jesse, for coming out.
EXP, Lane.